given the fact that we now have low rates, a $1 trillion stimulus pledge from the White House, and global easing now also filtering into the dynamic, do you think that perhaps the fundamentals have been set for a more sustained rally in risk assets in the second half of the year?
Well, I think we are going to have a rebound in the second half of the year. But near term, I expect the S&P 500 is going to bounce between 2,500 and I think we were pretty close to it a couple days ago. I wouldn't be surprised if we went down to 2,350, which was the 2018 low. So I think near-term volatility, but I think that all the things that the institutional market is looking at is we could have a tremendously strong rebound at some point in the second half of the year, snapback. And so I think I can tell by the inquiry from our institutional customers about a lot of equity products. And that, to me, is a sign that the market expects a pretty rapid rebound once we're through this.
So it's going to be fascinating to watch, isn't it? Either that V-shaped recovery or U-shaped recovery, depending on how you see the dynamic playing out. What are you telling clients right now, and how do you invest in this environment?
Well, I think you want to stay the course. I think it's too late to make too many adjustments on the margin. The crisis has already hit. I think what'll be interesting to me is I don't think you need to get too tricky here in terms of playing the rebound. My expectation is that a lot of the stocks that did very well at the beginning of the year and the end of last year will come back very strong. Now, having said that, what I would focus on is those companies that have good balance sheets and not a lot of debt, mid and large cap companies, because I think that those kind of companies are going to lead the rebound. The other thing you got to be careful of here is the turmoil in the investment grade corporate market. Investment corporate spreads are about 300 basis points. I think they offer a lot of value. And the primary dealer commercial facility that was just announced with a lot of collateral, investment grade corporates, commercial paper, that's going to help the market tremendously.
So all that talk about rising default risks, do you think that those concerns have been put to rest for now with all the measures that the Fed has taken?
Well, you're going to have defaults in certain sectors, no question about it. I mean, energy bonds are trading not on spread, but on price. And so anytime you see that, you're going to have defaults in the energy sector. Obviously, we're very concerned about the airlines, travel, leisure, restaurants, those kind of things. So I think it's very reasonable to expect that defaults are going to go up. And I think what the federal government is trying to do is to just ease the cash flow crisis so that we can get through this. But I'm pretty optimistic that a lot of these programs are going to help. And just like 87, we'll get through it, but it's going to be bumpy for a while.
Hi, I'm Emily Tan, and thanks for watching CNBC. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to the channel for more. Thanks for watching.